Silver futures margin spiked 50% overnight by the CME Group on December 12, 2025. The move slashed leverage positions, dumping prices 8% in hours. But physical premiums in Shanghai and Mumbai climbed 15% the same day. Backwardation stretched to $2.90 between spot and December contracts. Industrial orders from solar and electronic sectors held firm at 1.1 billion ounces deficit pace. Sovereign bids from India and China didn't flinch. The bank's kill switch triggered and jammed. Paper silver fractures from physical reality as we watch. Deliveries on COMEX surged 40% week over week. The system loses grip now. This isn't volatility, it's structural failure manifesting in real time. Look at the spreads. Futures trade below spot by margins unseen since 2008, when Lehman collapsed and silver backwardation signaled funding seizures. Here, in 2025, the gap isn't closing, it's widening. SLV ETF shares vanish from borrow markets, zero available for shorting or redemption into bars. Dealers report no lending between bullion banks. Rates for leasing physical silver jump to punitive levels, effectively halting interbank flows. JP Morgan shifts its precious metals desk to Singapore. Amid this, a quiet relocation that screams evasion of Western scrutiny. The paper system, built on infinite leverage and fractional reserves, hits physical limits. And those limits aren't bending. The symptoms pile up without resolution. COMEX glitches halt trading precisely when silver threatens breakout above $40, as seen November 28th. Thin order books cleared, no bids left. System pauses to let market makers reposition. Coincidence? Hardly. It's the same pattern from March 2025 slams. New York open dumps prices, recoveries overnight in Asia. The New York intraday silver index, tracking day session performance since 1970, sits at 8.19, a 92% erosion. Contrast the overnight index, up 19,900% over the same period. This divergence isn't market efficiency. It's engineered suppression fracturing under demand that won't yield. Now, trace back to where the breakage starts. The 1.1 billion ounce physical deficit in 2025 isn't a forecast, it's measured outflow. Industrial use alone, solar panels consume 200 million ounces annually, up 30% from 2024 as China ramps production. Electronics add 300 million. Batteries for EVs like Tesla's, another 150 million. These aren't speculators borrowing at 25-to-1 leverage. They're cash buyers locking in supply chains. Sovereigns layer on. India's government stockpiles 100 million ounces quarterly, no margin involved. When banks hike margins to kill the rally, they targeted the wrong players. The kill switch assumed a leveraged crowd that panics and sells. Instead, it exposed the paper overhang. Short positions from banks like UBS and Deutsche, heirs to the London fix scandals, where 11 o'clock rules coordinated dumps. Here's where logic snaps. In a stable system, margin hikes cool overheating. But here, they accelerate the split. Physical holders, those patient accumulators who positioned during 2023 to 2024 dips, watch their metal reprice upward while paper traders liquidate. Wealth doesn't shift dramatically. It flows quietly from the reactive to the prepared. Remember 1980, Hunt Brothers era. Rules flipped mid-game to liquidation only. No new longs, forcing prices down from $50. That intervention worked because physical demand was elastic, tied to speculation. In 2025, it's inelastic, rooted in manufacturing and geopolitics. The rule change failed because the system it protected no longer controls the asset. If you tracked silver futures versus physical premiums in your own dealings, how does this margin hike look from your angle? Does it signal control or desperation? Share your take in the comments. It might clarify where the next fracture hits. Interweave this with broader strains. Geopolitics amplifies the deficit. US, China tensions reroute silver from Western refineries to Eastern fabs. Logistics chains stretch by Red Sea disruptions, adding 20% to shipping costs. Military applications, silver and missiles, radar, hypersonics, pull another 50 million ounces covertly, unreported in public data. Banks, holding short positions, estimated at 500 million ounces equivalent, face cascading calls. Rumors circulate. JP Morgan flipped net long on COMEX, leaving counterparts naked. If one folds, margin spirals trigger cross defaults, echoing 2008 when silver shorts fueled AIG's bailout. But now, no systemic risk exemption looms without admitting the paper edifice's frailty. The media silence is its own anomaly. No headlines on the 50% margin nuke. No regulator statements from CFTC, despite emergency meetings floated. This quiet mirrors historical transfers. Wealth moves not in crashes, but in distracted phases. The impatient, leveraged shorts, emotional traders cede to the disciplined. Physical stackers, industrial hedgers who prepared below $20 in 2023. Compounding works here, not just in yields, but in positioning. Early accumulators see their holdings appreciate as deficits compound annually, from 800 million ounces in 2024 to 1.1 billion now. Patience isn't waiting, it's active restraint against noise. Compared to 2008, banks suppressed silver to $9, while physical premiums hit 50%, signaling the same disconnect. Then, it resolved in recovery to $50 by 2011. Now, the scale dwarfs. Global silver mine output flat at 800 million ounces. Recycling adds 200 million, yet demand breaches 1.2 billion. The LBMA's Ponzi, unallocated accounts promising metal without backing, enters criticality. Leases stop because funding costs exceed suppression benefits. Bullion banks fined billions in prior manipulations. Deutsche's $38 million settlement in 2016. Repeat patterns but face buyers who don't blink. This isn't conspiracy, it's observable signals. Korean banks suspend silver sales February 14, 2025. Coordinated, indefinite. RBI amends gold-silver loan rules September 30th, widening collateral scope. But that's adaptation, not fix. U.S. Regulators relax bank leverage November 25th, allowing less capital against low-risk assets like precious metals. Irony. Easing rules to hold more, yet shorts amplify risks. The system loses sustainability where paper promises exceed deliverable metal. Historical mirrors reflect this. 1970s inflation eroded intraday indices while overnight soared, same as now. If you're in the mining or refining sector, how do these backwardation levels affect your operations? Do they confirm physical tightness or something else? Drop your observations in the comments. They could connect dots I'm missing. Push deeper into the breakage. Volatility isn't danger, it's movement mispriced. Silver ETFs post triple-digit gains in 2025, yet underlying physical drains vaults. COMEX-eligible stocks dip below 100 million ounces, registered for delivery at 50 million. Fractions of annual deficit. When futures decouple, as in October 10th dump, where spot held while contracts cratered, it reveals forced liquidations for dollars, not new supply. Dollar spikes correlate, but physical refuses to follow. This inversion, paper weak, metal strong, marks the phase where control slips to holders. Geopolitics interlocks. China's resource war escalates, quietly countering Western tech announcements like Samsung's batteries. They hoard silver not for speculation, but strategic reserves, mirroring oil plays. India follows, diversifying from dollars. Logistics, supply from Peru. Mexico disrupted by strikes, adding 10% cost anomalies. Military draw, U.S. DoD contracts undisclosed, but silver and F-35 components alone pulls millions. The kill switch, meant to reset, instead highlights these interdependencies. Banks screwed up by assuming a closed system. Reality is open, with flows bypassing COMEX. The narrative flips cause and effect to pressure the point. Effects first, illiquidity, premiums, silent regulators. Causes emerge, decades of suppression via spoofing. Coordinated slams exposed in UBS Deutsche chats. But 2025 breaks the mechanic because compounding demand outpaces manipulated supply. Patience rewards here. Those who stacked during boredom phases, ignoring hype, now hold leverage. Emotional shorts react, selling into thin books. Disciplined buyers absorb. Wealth transfers silently, from banks' fractional schemes to physical sovereignty. If you followed historical manipulations like the Hunt brothers rule flip, how does this 2025 margin hike compare in your view? Same playbook or escalated failure? Weigh in below. Your parallels might sharpen the analysis. Scale reveals itself progressively. One bank failure, say, a short unable to cover, triggers margin spirals. Rumors of cascading, U.S. banking system exposed. Economic depression if unresolved over weekends, as with $67 Friday triggers. But this isn't 2008. Physical bidders are sovereigns, not bailouts. Tesla doesn't margin. They pay cash for conductors. The system fractures where leverage meets reality. 500 to 1, paper to physical ratios, unsustainable, against 1.1 billion deficit. Industry ties in. Silver's dual role, monetary and industrial, amplifies. 60% demand now tech-driven, up from 40% in 2010. Geopolitical rerouting. Western sanctions push Russian silver east. Logistics premiums add layers. History as mirror. 2011 peak followed suppression lows, but deficits were half current size. Now, compounding habits of hoarders, consistent buying through dips, positions them as the calm below storm. Banks, emotional in defense, change rules overnight, but rules no longer dictate. The media void signals deeper. No coverage of CFTC's rumored 72-hour buy bans floated December 19th. This omission isn't oversight, it's containment. Regulators tiptoe around LBMA strains suggests awareness of criticality mode, where small inputs yield massive outputs, like vault drains accelerating. If you monitor bank positions or ETF flows, what do JP Morgan's net long flip and other shorts tell you about vulnerability, stability, or tipping point? Share your interpretation in the comments. It could highlight overlooked risks. Logistics exposes further unsustainability. Shipping delays from Houthi actions inflate costs 20%, yet demand inelastic. Military, silver and quantum computing, radar, pulls covertly, unquantified, but estimated 10% of supply. The kill switch misfired because it hit paper, not these chains. Wealth shifts to those prepared. Patient industries securing contracts long-term versus reactive banks defending shorts. Broader, uncertainty is opportunity. 2025's policy shifts, fading FOMC impact, eroded NFP data, compound market anomalies. Silver, mispriced below production costs for miners at $25 all in, forces shutdowns, tightening supply further. History mirrors 1970s. Overnight indices exploded as intraday suppressed. Now, same divergence, but with tech demand absent then. If you're seeing similar patterns in other commodities or your local markets, how does silver's deficit play out there? Echo or outlier? Let me know in the comments. Collective signals build the fuller picture. The process unfolds without reversal. Paper fractures deepen. Physical premiums normalize as new benchmark. Banks' overnight rule changes, margins, leverages, expose desperation, not strength. The system loses control where fractional promises meet absolute deficits. Wealth transfers complete, from impatient suppressors to disciplined holders. No bailouts fix 1.1 billion ounces short. The phase locks in. Depletion irreversible, repricing inevitable. If you've positioned in physical or watched from afar, what phase do you see us entering now? Containment or breakout? Post your reasoning below. It advances the collective dissection. CME raised COMEX silver margins 10% on December 12, 2025, from $20,000 to $22,000 initial for non-hedge positions. Futures dropped 5% intraday, yet spot held firm above $65. Backwardation widened to $2.50 on the December contract, and physical premiums in Shanghai hit 8% over LBMA fix. Deliveries surged 35% month to date. Registered stocks drained below 120 million ounces. Industrial buyers paid cash without flinching. The kill switch fired and ricocheted. Paper disconnects from physical in plain sight. This isn't correction. It's fracture accelerating. Spot trades $67.40 as of December 19th, up 128% year to date, while futures lag in inversion, not seen at this depth since 1980. COMEX vaults lose metal weekly. Eligible down 40 million ounces since October. Outflows to Asia unmatched by inflows. JP Morgan closed its legacy 200 million ounce short between June and October. Flip net long on 750 million physical, relocating desks eastward. Counterparts, HSBC, UBS heirs to old fixes, face uncovered exposure as lease rates spike past 30%. The mechanism that held for decades strains against demand that compounds without pause. Symptoms compound without containment. Backwardation extends to 2027 contracts, signaling immediate metal values more than any forward promise. Shanghai warehouse stocks drop 20 tons in weeks. SHFE outflows mirror COMEX drains. Solar alone pulls 220 million ounces annualized. EVs another 180 million. Data centers layering undisclosed draw. These aren't leveraged bets, margin called away. They're locked contracts, cash settled in bars. Sovereign accumulators, China, India, add quarterly bids, no hike deters. When margins rose, they exposed the overhang. Paper shorts estimated 400 million equivalent, now scrambling as physical refuses decline. Here's the snap in logic. Margin hikes once cooled speculation, reset overheated paper. In 2011, 5 hikes in weeks crushed from $49 to $26 because demand flexed, mostly investment, elastic to price. In 2025, 60% industrial, inelastic above $50 substitution thresholds. Solar conductors, EV batteries, 5G interconnects. No viable alternatives below $100 equivalents. The hike targeted reactive longs. Instead, it liquidated forced shorts while physical buyers absorbed. Wealth flows not in panic sells, but patient holds. From fractional banks to absolute holders. If you've dealt physical silver through this margin move, dealers, refiners, fabricators, how did premiums and availability shift on your end? Does it read as transient volatility or permanent rerouting? Share your ground level view in comments. It sharpens where the split widens next. Interlock with deeper strains. Geopolitics reroutes flows. Tariffs, sanctions push Russian output east. Red Sea delays add 15% logistics premiums. Military, silver and hypersonics, quantum sensors, pulls classified volumes, estimated 60 million unreported. Banks defend positions built on unallocated LBMA accounts. Now criticality as vaults hit 140-year lows relative to turnover. Media quiet on the 10% hike. No CFTC commentary despite delivery spikes. Same silence as 2020 shortages, when premiums hit 50% before resolution upward. Compare mirrors. 2008 suppression held silver at $9, while physical vanished, resolved to $50 by 2011. Deficits then 300 million ounces, now 150 to 200 million, projected for 2025, fifth straight year. Mine output flat 820 million, recycling 210 million, yet demand breaches 1.2 billion. Compounding works opposite here. Deficits accumulate, not yields. Patient industry secured offtake below $30 in 2023 to 2024. Now reprice chains upward as spot decouples. The inversion marks phase shift. Paper weak, metal strong. Forced dollar liquidations can't drag physical down when bidders are strategic, not speculative. Tesla pays premium for conductors. Nations diversify reserves. The kill switch assumed closed leverage loop. Reality open, flows bypassing New York. If you track bank flips like JP Morgan's long pivot, what does it signal in your reading? Capitulation or repositioning ahead of breakout? Drop your interpretation below. Parallels to past turns could illuminate the trajectory. Scale emerges clearer. One short cascade, weekend gap, unable to cover. Spirals cross marginals. 2025 deficits lock depletion. No new mines offset solar ramp alone. History reflects. 1970s overnight indices soared as intraday suppressed. Now same, but industrial absent then. Regulators ease bank leverage in November. Allow more metals hold. Irony, feeding the shift they once contained. Industry binds tighter. Silver's conductivity irreplaceable in green transition. 70% demand now tech locked. Logistics expose. Peruvian strikes, Mexican disruptions tighten further. The misfire highlights interdependencies. Paper meant reset. Instead, spotlights inelastic core. If monitoring ETF drains or vault flows, how do simultaneous COMEX, SHFE outflows read to you? Coordinated tightness or independent squeezes? Let me know in comments. Aggregated signals build the map. Process advances irreversible. Backwardation normalizes as benchmark, premiums embed. Overnight rules, margins, halts, reveal strain, not mastery. System yields where promises exceed bars. Wealth completes transfer. Impatient defenders to disciplined claimants. No intervention bridges, 200 million short annually. Phase solidifies. Scarcity structural, repricing structural. If position physical or observed sidelines, what stage registers now? Managed containment or uncontrolled ascent? Post your assessment below. Collective calibration refines the dissection. Spot silver holds $67.40 on December 20th, 2025, after touching $67.30 yesterday. Up 128% year to date. COMEX December. Futures lag in inversion. Backwardation steady near $2.50. CME's December 12th margin hike to $22,000 initial. Drained leveraged longs 6% intraday. Physical deliveries accelerated 40% into month end. Registered stocks below 110 million ounces. Shanghai premiums firm at 10%. Mumbai dealers quote 12 to 15% over fix. The kill switch deployed and deflected. Paper bleeds while metal locks away. The fracture deepens without repair. JP Morgan completed its pivot. Closed 200 million ounce legacy short June-October. Accumulated 750 million physical. The largest single hoard globally. Desk relocation to Singapore finalized quietly, bypassing Western oversight as counterparts scramble. HSBC, UBS remnants inherit exposure now isolated. Lease rates pinned above 25%. Backwardation embeds across the curve to 2027, signaling immediate metal commands premium over any deferred claim. Industrial pull, solar at 230 million ounces annualized, EVs 190 million, data centers layering unreported, operates on cash, no margin buffer. Logic collapses here. Margin hikes historically reset speculative excess, forcing elastic demand to fold. In 2011, repeated increases crushed from $49 because investment dominated, price sensitive. In 2025, 65% consumption industrial, substitution impossible, below $150 equivalents in photovoltaics, conductors, batteries. The hike liquidated paper shorts involuntarily, while physical bidders, strategic, patient, absorb dips. Wealth redirects from fractional defenders to absolute claimants, compounding positions built below $30 in prior cycles. If you've navigated physical procurement through this volatility, solar fabricators, electronics hedgers, refiners, what do these embedded premiums and vault drains indicate on your supply lines? Sustained rerouting or temporary spike? Share your frontline read in comments. It could map the next constraint point. Geopolitics tightens the coil. Tariffs reroute Russian output east. Logistics premiums add 18% on disrupted routes. Military applications, hypersonics, sensors, draw classified volumes, estimated 70 million annually. COMEX eligible dips under 90 million. One-way outflows to Asia unmatched. Media frames the 10% hike as routine volatility management. Regulators silent on delivery surges. Same containment as 2020 shortages, resolved only after premiums doubled. Mirror 1980. Rule flips mid-game contained, because demand flex speculative. Now inelastic, rooted in transition chains, nations subsidize. Deficits compound fifth year. 149 million projected 2025. Mine output stagnant 820 million. Recycling capped. Patient accumulators, those who stacked through suppression phases, hold leverage as system strains. Emotional interventions, overnight margins, halts, expose limits, not authority. The phase entrenches. Backwardation normalizes pricing. Physical sovereignty asserts. Banks' reactive adjustments highlight miscalculation. Assume leverage crowd dominant. Hit wrong constituency. Wealth transfer advances silently, from impatient paper architects to disciplined physical custodians. No reset bridges structural 200 million annual short. Scarcity embeds, repricing irreversible. If tracking institutional pivots like JP Morgan's full reversal, how does this hoard and relocation register in your assessment? Defensive buffer or offensive positioning for ascent? Drop your view below. Layered interpretations refine the trajectory. Process solidifies without reversal signal. Spot decouples upward. Futures converge only on forced terms. The system yields where promises outstrip bars. Phase locked, depletion structural.